Hello, Jason Bates here, owner of Electrum Financial, located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you like the lowest rates at the lowest cost, then allow me to put my 30 years of experience to work for you. You've got nothing to lose. Here is this week's mortgage market at a glance. Rates have been lingering near the boundaries of their previous highs and lows, giving me a sense of anticipation for what's to come. I've been eagerly awaiting this week's events to provide some direction, but it seems like the wait will persist. The two pivotal events were the release of the Consumer Price Index, CPI, on Tuesday and the Federal Reserve announcement on Wednesday. CPI holds significant importance as a widely followed inflation metric in regular economic reports. It has consistently influenced rates over the past couple of years, and this time it coincided with a crucial Fed policy announcement. Now, in this week's report, the year-over-year CPI was expected to decline since it was exceptionally high 13 months ago. This calculation considers a 12-month period, and in the current month was unlikely to match the severity of the month that fell off of the equation. Looking at month-over-month numbers allows me to focus on the present and gain more specific insights. However, this week presented a standstill that remained unresolved. To put it simply, month-over-month inflation stayed well within a narrow sideways range that has persisted for nearly 2 years. As a result, it provided limited guidance for the much anticipated Fed announcement the following day. Most of the market had anticipated the Fed to maintain its policy rate unchanged at this meeting. The policy rate, known as the Fed funds rate, pertains to overnight lending between large financial institutions. It typically changes no more than once every 6 weeks and has limited impact on mortgage rates by the time the Fed implements the rate hikes or cuts. Longer-term rates, such as for mortgages, are more concerned with the future direction of the Fed's rate trajectory. During every other meeting, the Fed releases a summary of economic projections that includes the dot plot, which is a representation of each Fed member's assumptions about the policy rate in the near future. This particular instance of dots was significant as it would provide insight into whether the Fed was simply pausing rate hikes or if it believed it had reached a limit. Despite the CPI data lacking strong guidance, the dots clearly indicated an on average vote that moved 0.5% higher, suggesting 2 more rate hikes in 2023. Now, it's worth noting that the dots are projections, not predictions or forecasts, as emphasized by Fed Chair Powell during the press conference. In a more candid manner, Powell might express that the dots are more guesses based on current circumstances and that most participants tend to change their projections in 12 weeks when the next dots are released. Now, Powell further mentioned that the Fed hadn't even decided if it would hike rates again, taking a meeting-by-meeting approach depending on the evolving data. This increased the significance of economic reports in shaping the Fed's decisions, with some reports indicating strength while others hint at a potential recession. It's not surprising to see volatility and sideways range being persistent in the markets. Although the short-term sideways range for 10-year yields may not last much longer, it has served as a reliable guidepost in recent times. In the grand scheme of things, the range isn't a perfectly sideways one. It's more like a struggle to drop below the 3.4% level. As usual, the movements in the 10-year yields closely mirror the movements in mortgage rates. So, what does all this data indicate for the near future? Well, that's a topic of debate. On Friday, economist Justin Wolfers shared a chart that strongly suggests it would be unreasonable to anticipate a recession at this time, considering the majority of the economic data. Around the same time, Wells Fargo economists shared their weekly notes, discussing recent trends in the leading economic indicators index in anticipation of next week's update. They emphasized the significance of forward-looking indicators like leading economic index, LEI, in a world filled with lagging economic data. Unfortunately, the LEI has consistently indicated a potential recession. For the past 10 months, the 6-month average change of this index has remained below the historical threshold associated with an economic downturn. Furthermore, the decline in the LEI is gaining momentum, indicating a higher likelihood of a shift in the business cycle. The debate between recession and it's not so bad can easily go back and forth, especially considering other data released this week. Speaking of sentiment surveys, let's consider consumer sentiment itself. Although it remains historically low, it has shown a fairly consistent upward trend. Now, moving towards a more recessionary outlook, it's worth noting that weekly jobless claims have reached their highest levels since 2021 for 2 consecutive weeks. Now, moreover, when I remove the pandemic-related fluctuations, these levels are the highest since 2017. It's of my opinion that we are entering a deflationary period, which can be a good thing so long as prices don't fall too fast and for the wrong reasons, such as job losses. As long as there are convincing arguments for different economic outcomes, rates will likely stay mostly stable with significant and unpredictable fluctuations between the current highs and lows. So we're in a bit of a waiting period for now. So there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I'd like to be your broker of choice. Until next time, take care and stay safe.